Welcome to the new Barbarians podcast. I'm Bill Mann.
And I'm Mark Connors. And we're here to deliver insights on how current market events impact the traditional investment portfolios of stocks and bonds that Bill and I traded on Wall Street. Today, we see digital assets as the next frontier for finance and investment.
We're also here to explain how cutting-edge tools like AI and disruptive tech are the new barbarians at the TradFi gate.
So instead of Mike Milliken's innovation on debt financing with junk bonds, today's barbarians at the gate are changing the landscape almost daily across regulation, legislation, and finance.
So hit the subscribe button and let's cut through the noise together. Welcome to episode 12 of the new Barbarians podcast. Today's Monday, March 17th, 2025. This podcast will hit the platforms later today. Today's St. Patrick's Day. Yesterday was the 17th anniversary of Bear Stearns becoming insolvent over a weekend, and we will speak a bit about the history of both St. Patrick's Day as well as the credit crisis.
Aye, we will.
This past week, we had more turbulence, and Mark is going to cover that in a minute. Currently, the pre-market, is basically flat in the U.S. and Asia and Europe are up modestly. Mark's going to go through his usual scorecard, the current state of the credit market and investment fund flows. I will sprinkle in my experience researching and modeling historic market events, and hopefully we'll find something that's similar to what we're seeing today. And, in particular, I wanted to address what quants typically consider the official demarcation of the credit crisis in August of 2007, when Goldman's Global Alpha hedge fund lost 22.5%. So in light of Bear Stearns being March 16th of 2008, we typically look at the start of the credit crisis for historical modeling reasons to be August of 2007. So take it away, please, Mark.
Nice. Thanks for that, Bill. And yes, so on a few things here, we're definitely going to hit on the line of demarcation where everything changed when Bear Stearns went under and moral hazard still existed, or moral hazard was avoided when a bad bank was allowed to fail, but that will never happen again for reasons that we'll chat about here. On the market side, let me share my screen here. We saw an improvement in digital assets just over, let me see here. Yep, hopefully we got that going. Yes. So on the month, you saw Bitcoin barely down on the month, has picked up since being down as much as 5 or 6% in the month of March, recovering. And we mention that because Bitcoin often leads risk markets. And I think we're seeing, Bill, correct me if I'm wrong, a bit of a green on the opening, in the spirit of St. Patrick's Day. And futures up, Asia, Europe are up, and futures in the U.S. are up. So that 5% down, 5.3% down S&P in correction territory, peak to trough, may be reversing. But we'll talk about the persistence of that in a minute. So that's what month to date looks like. The reason why we have the year to date and the 1 year is to we provide perspective. Context is important. It enhances everything. As opposed to Bloomberg says, context changes everything. It doesn't change everything. It enhances the outlook, or it enhances the information. So since everything is about Trump and tariffs, what we're going to touch on today is looking at data, markets, and processes to figure out how do you price in tariff impact into your portfolio, your lifestyle, and your consumption pattern. So what we look at is year to date. Coming into March, we're already down in February. We started shifting about a week after the election. So the question is, Are we going to have a behavior like we had in 2024 or the trailing 1 year where gold was up 40%, equities were up on a trailing 1 year basis 10, 11%? Or are we going to have something like 2025? What is the persistence in performance last year or this year? And we think it's going to be going more along the lines of our third graph coming up soon here. Our second graph, rather, we show you right here. We think the persistence in patterns will follow 25. Here you have gold up as a haven, up 14% year to date. That's, again, building on up 28% 2024. And Europe. So Europe is a haven today because when stuff goes sideways, like you have tariffs at a level not seen since Smoot-Hawley, 1930. So how do you figure the impact on an event that is not in a regular quarterly annual time series? What do? You get low to ground. You go to places like Europe because the stock market has a lower price earnings ratio. It's not because it has better growth prospects, better earnings. It's just not as risky meaning high PE, potential loss. So people are going into this asset. It's not going to persist. It's only a $4 trillion market versus the US $55 trillion market, $60 trillion equity market. It is not a safe haven. Gold is more of a persistent safe haven. So let's keep going down this list we have here. Treasury bonds. Treasury bonds will still be a safe haven for the interim period. You look at the IEF, which is a 7 to 10 year Treasury bond index, ETF rather, and then the AGG, which is a proxy for the Barclays Bloomberg bond index, which used to be Lehman. Very timely here, obviously, as we look at Bear Stearns, which led to Lehman's, was a precursor to what happened to Lehman going forward in September of 08. So the bond index, all people shoving money in there, equities down. Let's shift it to digital assets. So here you have an outlier. Things make sense. Bitcoin up or down the least, down 12%, Cardano down 21%, Solana, and then you see Ethereum down 43% year to date. But XRP is an outlier. XRP is an odd animal because it is one of the older blockchains. It also is one of the largest marketing machines out there. They call the XRP tribe of followers the XRP army, not just because of the corporation with Garlinghouse and Larson, but also because of the committed coin holders in the XRP community. So that people think they've aligned themselves with Trump, and they may get a say in or may get some love from a regulatory standpoint. Bill, let's put remind me to come back to that and how the recent executive order I'll touch on about why I think that XRP outperformance year to date, I think it's going to change in the next quarter.
I will remind you, but I also did want to bring up, didn't the Bank of Japan adopt XRP as the interbank transfer cryptocurrency, last year or the year before?
So I'm not aware of that. So we will, since we are large language model monsters, we will have something back for people before the end of the podcast.
Cool.
I will come back. But yes, so people are looking, they're saying that it's Franklin Templeton's talked about it. So there's a reason why people are embracing it. I go back to our model, pulling from St. Patrick's use of the 3-leaf clover to celebrate or to explain the Holy Trinity to the Irish and convert the pagans into Catholicism. The blockchain trilemma, the 3 clovers of the blockchain trilemma are decentralization, security, and scale. And no blockchain can achieve all 3 well. But in creating, I think, a sound blockchain, you have to do 2 very well before you do the third, which is decentralization. So no one entity or person can contravene the blockchain and roll things back. Very important. Second is obviously security, so it can't be hacked. And then you can scale. Once you have a sound foundation of decentralization, security, and scale, then you can scale. XRP is centralized. I just don't see how you can add value over time. And that's my Bitcoin commercial for the moment. So now, Bill, this is the celebration of, or the commemoration of Bear Stearns. And, we were at both, remember the day, we remember people where it was worse for them as equity holders. But when we look at tariffs, which is today's contagion, not credit, but it is global macro contagion, unless it hits the credit markets, I don't think we're going to have a persistence of a bank failure or something that will be knocking on to bring about permanent destruction of value. And what everyone's looking at here is the long-running credit history, the green line, of the high yield bond index versus the investment grade. So blue is the blue value shaded area is a high yield bond indices through the CDX. And you're looking at it, through the high yield index. And what you're looking at is, something along the lines of a middling high yield spread or high yield, nothing outlier. But what's amazing is that high yield relative to investment grade is near its all-time lows. It means that people are still very risk seeking. They are seeking yield. They're not averse to the potential for loss. And until that changes, we're nowhere near contagion. So that's something to keep on your monitor. If you don't have that index, you can get it through the St. Louis Fed. Give Bill or I a shout out here on the link or in our social media. And so now going back to behavior, you are seeing some people get low to ground. So this is the one-day flows from the 13th last week versus 1 year flows. You're seeing SPY out, you're seeing IVV. Now, the move in the IVV, which is Vanguard's index, is meaningful because it's the lowest cost index. It's also had the greatest flows into it over the past, in 2024. This is 1 year flows. But in 2024, it had the most flows of any index. So to see it go down, any ETF, to see it go down 15 in 1 day, we'll see if that pattern persists. But guys, look at the other proxies. Look at the bond proxies. They're all up. So flows are going into them. And look at the flows for the T-bill, the 3-month T-bill. As a percent of total 1 year flows, it's the most. That's 300 million over 10 billion. And then look at gold. We've seen flows into gold. It's only 100 million versus 7.7 billion. That's only 1 day, though. The persistence for gold has been there. And then look at Bitcoin. We're seeing flows into Bitcoin. That's why you're seeing that reversal. So people are definitely moving into safer havens. We're putting Bitcoin into that, even though from day to day, obviously more variability. All right, the next chart. So we're going to look at this, touch on this, because this is on global macro when we're talking about contagion in '08 being about credit. This is about not banking, but it's about sovereign behavior. It's about what is the Federal Reserve doing? They're still cutting their balance sheet. That's the dark blue area graph. They're cutting it, but at a lower degree. Even though the Fed has been cutting, other factors have made M2, which is in the lighter gray, move higher on the year. So M2, or global liquidity, which is credit creation, maybe the treasury infusion, deficit spending, that's making liquidity go higher. So while the Fed takes away, the treasury is giving. So even though Besson is being a hard ass and saying that, and listen, there's got to be a period of acclimation, equity market's going to go lower. When it comes to credit and flows, they're not really going to turn off the faucet in the aggregate too quickly because they still have to sell over $10 trillion in treasuries. So a lot of moving parts. I'll leave it with this graph. This graph looks at the 1 year rolling basis, which still shows on average The Fed has taken down the balance sheet 10% over the past year in aggregate. But if you look at a quarterly basis, it's only 8%. And if you look at a monthly annualized basis, it's only about 6%. So the pace of reduction is slowing at the Fed. All eyes on them for a hint of whether they're going to cut rates and be more dovish going forward. So that's why I ended on this graph, because the Fed's going to be front and center this week as people look at it. But what do I think? I think that you still have to be looking at the fund flows and whether or not you're going to see a crack in the MOVE index, Bill, which is the VIX for bonds. Because when you and I were at where were you located when you woke up, you're ready to go to the Blarney Stone, meet your friends at lunch for a corned beef sandwich and a beer like I was, but you couldn't because I was at a credit fund, Bear Stearns happened, and the world was on fire.
Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe. It really helps us grow the podcast and bring you great content. Thanks for the support.
What index were people looking at in the credit markets that no longer exists today as a useful indicator of contagion?
So I don't know if I was getting ready to go out to the Blarney Stone or
was that an overshare by me that maybe not everyone did that?
No, I was reverse commuting out to Wilton, Connecticut to go up to AIG Financial Products, but yeah, I think the TED spread is probably what you're looking for, and
yep,
overnight,
definitely one of them.
Overnight banking rates, and yeah, I mean that was back in the days of LIBOR and other things that no longer really are relevant. So I don't, certainly by the time Paulson came out and was fully supporting the banks after Lehman, but somewhere between that year and a half, and there were so many different government programs that were meant to support banking. Remember, like the window, it would have been like spelled demise if any bank ever,
Yep.
So yeah, it's like night and day, I think. Back in the day when we thought banks could go bankrupt and there weren't systemically important financial institutions and all these other regulations that literally changed the definition of what banks are. So yeah, but to really answer your question, I think we were looking at and even by the time, so we were kind of the last bank in a daisy chain of risk transfers. And so AIG Financial Products was holding the super senior credit default swaps of banks that were transferring the risk of CDOs with subprime MBS exposure to us ultimately.
Mm-hmm.
So we were experiencing this, back all the way, I know you actually mentioned Northern Rock. So that was like March of 2007.
Yep.
And then, Countrywide and, WAMU was late relatively, but Countrywide and IndyMac and some of these other crappy subprime banks blew up in the summer of 2007. And, I think the collateral calls started coming in, probably around the time of the August 2007. No one ever even spoke about a collateral call with a super senior tranche of a CDS of a CDO until then. But by the time Bear Stearns went down, we were certainly experiencing a lot more than the rest of the world. Like we were keeping an eye on counterparty credit risk by that point.
So we're not, back to when you talked about 2007, March being the start of it, the silent rumblings, which actually did appear in some of the cross-market correlations that we look at, and that I was using at the time as a credit risk manager. So there were more than rumblings. There were huge moves in cross market correlations, and as you said, that was March. It didn't hit, obviously cause a problem for global alpha until August. They were obviously having some bleeding before then, but the reason I think it's relevant to go back to this period is it was a global credit, eventually liquidity crisis, liquidity and then credit rather. But we will never have that in the banking system again because the central banks are now where the risk lies. They're supporting the banks. They're captive, as you said. And that's why what Trump is doing is very disruptive, because it forces central banks and other governments to change their behavior. The thing that the Fed was able to do is to say, I got everybody. Instead of saying to the banks, you figure it out, they said, I got it. And they just wrapped, as you said, a lot of programs around everybody. $280 billion to Citibank. They did this thing called the TLG, was it? Term loan guarantee to corporations. 3-year paper was like government agencies.
Yeah, it was like TALF, TARF, TARP.
Yep, TALF, and there's a lot of acronyms. A lot of people always want to sort of fearmonger and say, just to get eyeballs. The reason why the world stayed together from a financial basis since '08 is because the central banks were relatively coordinated. The U.S. provided liquidity in dollar swaps to everybody after '08, so that if Hungary had a problem, they would give them enough dollars so they wouldn't have a run, because everyone wants dollars in a crisis. But that seems to be changing because the U.S., have a unique debt problem. And Besant has said we have to deal with our deficit. That's his, 3 arrows: 3 million barrels a day of oil, 3% growth, and 3% deficit. And it's not going the right way. Our deficit is up 50% on a year-over-year basis in the first 4 months of the fiscal year. So back to why we're talking about '08. And now I'm going to sort of push it back to you and some of the sentiment indicators you're looking at. As a risk practitioner, as an investment, a quant, a fundamental person, how should you look at something that hasn't really occurred that frequently in the last 100 years, a tariff war? How should you look at that impact in your existing data? And is there new data you should incorporate in order to be informed in a very structured manner about the potential risk of a global alpha, of a Bear Stearns in today's terms? Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe, as it really helps us grow the podcast and bring you great content. Thanks for the support.
So, these types of things are probably the $1 trillion question. If you can predict the unpredictable, then you should. It's kind of like having the betting playbook that Biff gets in Back to the Future Part 2.
You get 10 points for that one. Nice job.
Yeah, I love Biff. So the real answer is, you're always looking for a signal versus the noise, and there are lots of noisy things out there. I just saw Besant says that he doesn't see a risk of a stock market or of a I guess, we may be headed for a recession, but I forget what he said. But, he's out supporting the market, but he still says that corrections are okay. They're healthy. But, we don't have a huge market sell-off. And increasingly over the years, I think you are looking to the government and the Fed in particular to signal anything. If they came out and said they're going to cut rates, the stock market would shoot straight up. And maybe we'll expect that, but I'm dancing around it a bit. I think so. There are two things. You have alpha data, and then you have risk data. That's in theory separate. A lot of times they're the same, but what you would typically do as a quant is look over history and say what period is similar to this. And since we've been in a permanent, like what we call a regime shift since the credit crisis, it's increasingly difficult to find these situations in history. And then you add Trump and wars and all the other geoeconomic stuff to the mix, and it's really difficult to say, yeah, today looks a lot like whatever period, and you do have plenty of events over the last 17 years. Let's just say that that's like the period that we're going to constrain our analysis to. And what I think you do as a risk manager, like an independent risk manager especially, is just look over the entire history. Let's just shock the portfolio with every event, and then we will basically do this scenario analysis and consider what would happen if we had a taper tantrum or a flash crash, or you name the event that we've come up with these sort of fun names around.
Yeah.
And then you say, okay, how would we do across all of these different things? And if it seems reasonable that you don't need to cut risk or change your entire portfolio, you just set it and forget it. But in the search for the actual signal versus the noise, if you do find an indicator that you believe is kind of a risk on, risk off type of indicator. So when this indicator goes above a certain threshold, maybe that means, yeah, this is actually scary and we should model things differently. You can actually add that to the portfolio, and then it would be a risk or alpha factor. So if you're in a down market and you have an indicator that says this sell-off is too severe for the current conditions, you can buy more. And that's kind of the ideal thing to do as an investor is, buy before everyone else starts to.
Yep.
And then, you add tariffs to this. We did have like threats of tariffs and some of that with Trump 1. And you can kind of look at that and at least look at the sectors and the stocks, so ultimately what I think you want to do is find a basket of stocks that will either benefit or, suffer through this regime. And you want to buy or sell that basket of stocks or, basket of global assets.
And people have done that pretty quickly already, where utilities, healthcare, some of the defensives. So this has been a classic risk aversion with, and I don't know if some of your research has shown otherwise, that is not necessarily tariff sensitive. It just follows that classic, at least look at the US market, the classic defensive, large cap defensive, model.
Yeah, and I would say that applies across the entire global asset allocation spectrum. So it's really just risk off recently. And I think you see the same thing in crypto. You see the same thing in, certainly the stock market, like you pointed out. I think people are in Europe mainly just because it seems safer. It's not because they really like the, growth potential for European stocks.
Yeah.
And, last time I think we mentioned that it probably doesn't even have the capacity to take, a real shift in sentiment across the U.S., investment management industry. It's just not big enough. It would become way too expensive, way too
No,
fast.
and Donald Trump, Bessent, all know this, and that's why they can use the cudgel of being the reserve currency, where we can behave in a certain manner, and people still need to transact in dollars because there isn't enough yuan or euros or yen in the world to act as a medium of exchange. Just doesn't happen, and or even a store of value. That's why treasuries still, even though their prices of the medium-term bonds are still down over a 1-year basis. You lost money if you bought them a year ago, which is crazy, but it's true. It's because you can't store it and everything. It's a really weird concept. But going back to the anniversary of Bear Stearns going under, where the game used to be between banks to allocate capital, it's forever gone. All right, I'm going to bring something up. Today's also the death of Forever 21, the millennial retailer. God rest Forever 21, gone the way of the hula hoop because of places like Amazon, consumer behavior, and let's just face it, a pretty poor line of clothing. But I digress.
Was that the one that had the really racy billboards and stuff?
Yes.
Yeah.
Yes. Sometimes it doesn't sell. So, so that allocation of capital, which was, banks would be the arbiters of risk. When we were banks growing up, you had prop desks. They were a warehouse of risk. Now it's like shit through a goose. Banks are not sizing and pricing risk anymore. It's at the government level. So Trump knows this, and he has an advantage. The U.S. has an advantage because they can press bets longer without having any long-term impact, really, to it. Things can break, but, the flu the cold that the U.S. catches is a flu for every other sovereign out there. So that's what has people concerned because they understand Trump is a wonderful negotiator, and now he has the best platform, strongest, not just from a military, but from an economic standpoint in order to negotiate. And folks, the game is on, and that's why I think the number one index to look at is no longer as we said, the T-bill. What's the
TED spread?
The TED spread, 3-month bills versus overnight. It is the MOVE index. It is the report card of the volatility and appetite for treasuries globally. And it spiked up in February. It's actually come down a bit now. But that's the number one index, I think, that any risk manager or allocator should have on their dashboard.
So, Mark, I do need you to clarify one thing now that you've probably marked us for profanity. What exactly is shit through a goose?
Oh, okay. Yeah, so that isn't anatomical, not a profane reference. So as we know, when geese eat, it really has a matter of hours before it is out the other end. And in the old days, say a hedge fund or a asset manager came into a bank like Bear Stearns no longer exists, Credit Suisse no longer exists, or say another bank like JP Morgan that does exist. So point being, a lot of banks are out of business. They would say, salesman would get a call, and would say to their head trader, all right, Fidelity has 10 million shares of IBM for sale at the market, not held. What can you do? The trader would say, hold on, Fidelity, okay, like the account. I buy 5 to work 5. So that means they took risk. I'm buying 5 at the buck at 98. I buy 5 to work 5. So therefore, Fidelity's out of 5. They give the order for another 5, and then the sales force goes out and tries to sell another 5 million or total 10. But that's taking risk. Today, it simply is into the machines and algos. No one takes risk. It's all done through um, electronic systems. There's not much upstairs calls, not many desks taking risk because they've been hamstrung by regulations. So that's what I mean by poop through a goose. Now that you kind of gave me a little, made you self-conscious about that. Since this is a family show, we want everyone to be able to listen to our nuggets of wisdom. And that's why the banks matter less. There are fewer of them, their capital is lower, and their appetite for risk is lower. So that when the central banks do something, as you said, if they say, oh, we're dovish, we're hawkish, markets spike. They move immediately because there's no mechanism to absorb risk up or down. And that's not very stable. And it leaves a lot of responsibility on the shoulders of Treasury, which is very active right now, Bessent, very vocal, and the Fed, which, in my opinion, has become a little less vocal.
And I know we're gonna run out of time soon, so I'm almost reluctant to bring this up. But if I were to express some concern about the current outlook and be a little Debbie Downer, I would ask about private credit. So, we haven't seen spikes in credit when we look at high yield, and it seems like investors aren't that concerned. But I would also argue that there's a lot of private credit out there that is not being marked to market right now. And you might see this through banks with hedging and stuff like that, but for the most part, I'm not sure we would see early cracks the same way we used to, especially in high yield bonds. May not be the same representative that they were back in those days.
That's number one nugget drop today. I agree. It is a fraction, and it's less liquid, and it's a fraction of the market, of the total risk non-investment grade market today than it was on that March 17th, 08, when the unimaginable happened, where you had the largest bankruptcy in U.S. history with Bear Stearns.
So I'd love to get someone in the private credit market on here to tell us, but I have a feeling they would have a conflict of interest.
It wasn't a bankruptcy, right? It was an acquisition. Sorry about that.
The JP Morgan acquisition.
That's right. The JP Morgan acquisition, just like UBS bought Credit Suisse. Yes, I think we should have someone on because the Apollo Group is the quietest behemoth emerging in our financial industry in the last 5 years.
Yeah.
What they've done is nothing short of Herculean in creation and disintermediation in credit markets. What could go wrong, Bill?
It might be difficult to get someone from one of these really quiet, secretive places to come on here and tell us that there's a huge problem with their inventory.
Yeah, about how to price something that the pricing service is moi. The person owns the asset.
Yeah, they might not want to signal to their counterparties that they have. When you brought up the goose thing, I was thinking, I see that all the time on golf courses, and maybe those. Once those places get littered with that, the fairway's ruined.
It is.
It gets on your golf ball. It's nasty.
How about the visual of seeing that field and then having the tractor that picks it up called private credit? Would that be would that be not welcome to our friends? All right.
There we go. And so I think, not that we usually get to close out our discussion with, a big revelation and conclusion for our listeners to take away, but I feel like things actually got a little bit better if you just look at some of the reversals last week in the stock market. So momentum had its really bad week 2 weeks ago, and then last week was better. Short interest, so it was really a reversal of some of this. I'm looking at the market now; it's kind of flat, which is welcome if you've been sort of sweating through the
Yeah.
volatility. Um, I feel like maybe we're on to something when we say that we haven't seen anything yet that is a true indicator. And I personally like buying dips, and
And again, not investment advice, family show, and do your own research. But in support of what you said, Bill, coming from the credit markets like you, absolutely, the move index is still sanguine. I think it's like 102. 140 is a reading that will indicate stress. And look at incentive structures. Trump has 2 years midterms. He's a 100-day guy, so that's coming up. And the stock market can be sacrificed. The credit and treasury market cannot. And they're behaving okay. So we are not in DEFCON 4 right now. This is a normal bloodletting. We see it every year. There's going to be, I think in July and August of 23 and 24, we saw a 10 to 13% drawdown. That's what we had up to now. So we can go another 5%, before we get to a full bear market. And I still think that that the markets would be in control and could be reversed out. So that's my 5 cents. The way things are going, though, by next week, we could get the answer on how our thoughts were today.
Yeah, and I guess since I brought it up earlier, I did just look again. The Besant, I don't know where he was speaking, but what he said yesterday is that he's not at all worried about the stock market, adding that corrections are healthy. And then he couched that by saying there's no guarantees of avoiding recession, but not to get conspiratorial about the financial press, but then it's semicolon Fed meeting looms. So to the extent that these things are signaled, like if there is a looming recession, the Fed meeting is probably going to address that. And I do very much believe that the Fed is going to control what happens, and they probably won't let anything too terrible happen.
So. I agree with you, and I think the next move will not be preemptive because they did that in September and the market didn't like it. I think we're going to expect dovish language, neutral to dovish, and which will indicate that if we do have a follow-on from the negative GDP now number that we talked about last week, which was export driven, which just means people imported all the goods before the tariffs hit. So that's a one-time event.
And that was before the tariffs hit, and they still haven't hit, right? So, all of this is still fear of tariffs and potentially
on April 2nd. Yep.
Potentially negotiations that are being done at the highest levels of government and stuff. So
we have tools to help navigate markets, thank God, and we have a new actor at the top of the financial pyramid that is playing a very different game in the open. And we're seeing the impact in equity markets. But as we said, I think that there are adults in the room who understand that if you start to really make big waves, those PCBs in the bottom of the Hudson can lift off and really contaminate the whole system. So that is how I would end it on the market risk side. Move index, flat, and credit spreads still plumbing lows. So markets are settled and we can absorb all but a 20% decline in equities, I think.
Cool. Well, on that note, I think we should sign off. Happy St. Patrick's Day.
Happy St. Patrick's Day, everybody. Take care.
Thanks a lot. Bye.